it became clear to me that there was something else going on, that it wasn't really necessarily about the technology, but there was something else in the water that was kind of creating the behaviors and incentives that were driving, how technology was impacting the people we were, working with. And long story short, came to the conclusion that it wasn't actually about the technology. And that, for me, was really like the aha moment that once I had it in my head, I couldn't get it out, and sort of led me down this rabbit hole of researching and writing the book. So it is really written from the perspective of somebody who is dealing with the downstream ill effects of technology and trying to understand why it works the way it does, and especially how it impacts the lives of just normal people.
My name is Kristen Salmon, and I am representing the Global Fund for a New Economy. We are a newly formed foundation that is working to build political economies that are more inclusive, just, and sustainable. We play 4 functions in the emerging new economy ecosystem, including regranting, field building, and what we call building the connective tissue within the field. And we focus on 2 kind of policy arenas, one of which is the political economy of AI and technology, which is what brings us here this evening. And I hope that you'll join us after the panel for cocktails and an informal reception, and you can learn a little bit more about our work. But this evening, we're thrilled to partner with Catherine Bracey on tonight's event, World Eaters: How Venture Capital is Cannibalizing the Economy. We're honored to support her work and this crucial conversation this evening. So please join me in welcoming Kate Conger and Catherine Bracey to the stage.
Hi, everyone, and welcome to tonight's Commonwealth Club World Affairs program. My name is Kate Conger. I'm a technology reporter for the New York Times and the co-author of Character Limit: How Elon Musk Destroyed Twitter. And I'm also your moderator for this evening. A few reminders before we get started. Tonight's program is being recorded, so we kindly ask that you silence your cell phones for the duration of the program. Also, if you have questions for Catherine, please fill them out on the cards that were in your seats, or if you're joining online through the YouTube chat. It is my pleasure to introduce Catherine Bracey, author of World Eaters: How Venture Capital is Cannibalizing the Economy. Catherine is a civic technologist and community organizer whose work focuses on the intersection of technology and political and economic inequality. In 2016, she founded Tech Equity to tackle a simple but ambitious question: what would it take for the growth of the tech industry to benefit everyone? Previously, Catherine served as Senior Director of Partnerships and Ecosystem at Code for America and founded Code for All. Catherine, welcome, and congratulations on the new book.
Thank you.
I've been having a really fun time reading it, and I think it's one of those things where I think working in the tech industry, I think I have a good understanding of what's going on in the world of venture capital, and then diving into this book, I just, every other page, I'm having this kind of like WTF moment. So I'm learning a lot from it, and I hope that you all pick it up and read it as well and have those experiences, because there's a lot there, even if you think you know how this industry works. So let's just start with how you came to focus on this subject for your book. What drew you to the world of venture capital and made you want to commit your life to writing this story?
Well, I don't know if I committed my life, but definitely several years of it.
I know how hard it is to write a book. It takes time.
Yeah, it does. It definitely was all-consuming. Well, so at Tech Equity, we work on issues at the intersection of tech and economic equity, with a primary focus on housing and labor issues, because we think those are the 2 most critical inputs to the economic prospects of an everyday person, and they happen to be 2 areas where tech is having a lot of influence. And in the course of working on those issues, being sort of, I guess, downstream, and looking at how these technologies were impacting people's lives, it became clear to me that there was something else going on, that it wasn't really necessarily about the technology, but there was something else in the water that was kind of creating the behaviors and incentives that were driving, how technology was impacting the people we were, working with. And long story short, came to the conclusion that It wasn't actually about the technology. I think many of us who focus on, ethical tech or responsible tech or, even, tech in the political economy are really focused on the technology layer without really understanding the capital that surrounds it and how the capital that surrounds it infuses it with values. And that, for me, was really like the aha moment that once I had it in my head, I couldn't get it out, and sort of led me down this rabbit hole of researching and writing the book. So it is really written from the perspective of somebody who is dealing with the downstream ill effects of technology and trying to understand why it works the way it does, and especially how it impacts the lives of just normal people.
Mm-hmm. What were some of those sort of core values that you were seeing over and over again across tech companies that you realized were being drawn from the world of venture capital?
Well, I mean, I think move fast and break things has kind of become a, sort of cliche tagline that has been, a playbook that has been run many times, currently being run in the federal government. And that sums it up, really. It's like, get as big as possible, as quickly as possible, and damn the consequences. I focused at the time when I was researching and writing, the playbook that I was focused on was a book called Blitzscaling by Reid Hoffman, which, was very explicit about needing to, basically successful venture-backed founders needing to operate with a sense of sort of intentional thoughtlessness, and that sort of shipping faulty products or skirting regulations was sort of part of the strategy in order to take full market share as quickly as possible so that your competitors could not get a foothold. That it plays out in different ways in different markets and different types of companies, but essentially it boils down to get as big as possible, as quickly as possible, and somebody else will worry about any fallout from that. And the somebody else is usually, society at large, or customers or workers, or, us, citizens of a democratic republic. So yes, it's move fast and break things.
Mm-hmm. And what is the ideal model that venture capitalists are pursuing when they invest in companies? What are they trying to create there?
Yeah. So I guess the most important aspect of the mainstream venture methodology is something called the power law. Just a little brief history of venture capital. So it was sort of pioneered, I guess, in the middle of the 20th century in response to a real problem, which is that there wasn't enough capital in the financial system to fund risky breakthrough companies that were bringing some promising technology to market, finding ways to commercialize it and build companies out of it. And these things could be the engine of a very dynamic economy. It was post-war, there were a lot of technologies that came out of World War II that were promising, and people wanted to see if there was a commercial application. It was also the start of the Cold War, where there was a political imperative to show that capitalism could provide a better life for its people than communism could. And so this problem of how do we bring more capital into this economy that can fund these risky companies was solved by a hypothesis that if we can spread the risk around, so if we take a portfolio approach where we get, dozen or a few dozen companies into a bucket and have investors fund the portfolio, that some of those companies will succeed at an outsized rate, and a lot of them will fail because they're untested, and that the outsized successes will be so successful that they will more than make up for the rest, and that if we can do that in sort of a bucketed approach, that investors will be attracted to that. And it worked, and that hypothesis was proven correct, that when you invest in companies that have this sort of high risk, upside, whatever, that in a portfolio approach, investors can make money off of that. So that is called the power law. That's what that looks, it's called the power law. It's a distribution where there are a few very large values and a bunch of very small values. And that became sort of the methodology, or at the time, it was more of an observation that when you invest in companies in this way, a power law will be the natural result. Over time, and I think this probably happened subtly, but like over the course of like the late 90s, 2000s, early 2010s, it became about the power law. So fund managers began to optimize for power law returns rather than for identifying breakthrough companies. And then they kind of reverse engineered every company in their portfolio to fit a power law. And by doing so, they forced all of this, forced this playbook that I just described onto every company that got venture funding. Whether they were truly able to achieve those outsized returns or not, every company was forced to try to achieve them in order to make this power law real. And there are only a very small number of companies that can naturally achieve that kind of outsized growth. I think Andreessen Horowitz has said maybe like 15 companies a year. Mm-hmm. Meanwhile, there are thousands of startups that get started every year. There are thousands of venture capital funds, and they're all trying to chase those 15. So they force all the rest of those thousands of companies to run this playbook, and that's where I think the fallout comes from.
I think there's something of the mythos of venture capitalists that they have this spidey sense for those special businesses, right? That they can just kind of sniff out and detect those 15 success stories from the sea of startups that come in front of them. And something that you wrote that I thought was so interesting was that part of building this power law portfolio is to have failures in there and to have companies that as you invest, you maybe know or understand that they're not going anywhere, but you need failures in the portfolio to make those other successes look outsized. Can you talk about the way failure plays into these investments?
Yeah, I mean, I think it's a little more subtle than that. It's not that they actively want their companies to fail. It's that they see failure as a signal that they are operating in the right way to achieve the power laws, right? So like a power law is defined both by its outsized successes, but also by its long tail of failures. And so if you're trying to fit your portfolio to that return profile, you need a bunch of failures, right? And it's better for a company to fail early than sort of chug along and sort of making linear progress and never have any sort of end game to get to a liquidity point where they can return to their investors and say, here, we have this, payout to you. So I would say it's less about like they're optimizing for failures than they are taking failure as a signal that they're on the right track. And maybe that subconsciously sort of pushes them to push company. Like it's okay to push harder because if they fail, that's actually fine. That's a signal that we're on the right track. So I can load these companies up with more risk, and if they don't survive that, then that's still okay.
Interesting. There's a quote in the book that says, in the old days, companies competed on the merit of their products. Now they compete based on how much money they can raise. Can you talk a little bit about the way that the venture capital model has sort of substituted larger and larger fundraising rounds for innovative technology or commercial success?
Yeah, well, so the way that the VC ecosystem works is that companies raise in rounds. And so, it's like Series A, Series B, and then there's like, even before Series A, there's seed and even pre-seed. And every round is sort of the company in theory has reached a milestone or has proven that, they've gotten more traction, expanded their market. And obviously the further along you get in the alphabet, the more, mature and the company is and less risky it is supposed to be. So in the earliest stages, the early stage investors are not this company that they have invested in isn't profitable. There's no they haven't necessarily found their full market yet. There's no hard data to show that this company can be, reach whatever valuation they expect it to reach until they sell it to a future round investor. So another investor comes in to fund the Series B or whatever and decides to do so at a certain rate. Then the Series A investor is able to go back to their limited partners and say, see, this company is worth even more than it was because this next stage investor was willing to pay more for it or to invest at a better deal or a worse deal. I don't know. make the earlier stage deal look better by comparison. And then they're able to they use that to raise money from their investors, the limited partners who put their money into venture capital funds. And that's the incentive structure for an early stage investor. There's no, public market. There's no, for years down the road, if ever, they don't really care about the customers that much because they're only in it for the short term. So their game is to sell it to the next round investor. And all they have to do is convince the next round investor that it's more valuable than they paid for it. And so that market has sort of warped what startups are for and what they're optimized for. They're optimized to show the next round investor that they can be a more valuable company. They're not optimized to show that they are a solid business.
Right. I think usually in that fundraising round process, that's where I start to hear from startups. They view it as sort of a mark of approval or a validation of their business thesis. And there's reporting in your book about founders who take on VC and have that feeling, have that experience of this is a validation of what I'm doing and a mark of success, and then kind of get chewed up and spit out by this industry. And I'm curious how often you found in your reporting that founders felt as if they had no other option than to take venture capital, or that they felt that that was kind of the only route that they had for their business to succeed.
Well, first of all, I'm thrilled that you're calling it reporting. It makes me feel so, I had, dreams of being a journalist one day. So, yes, my reporting showed, chatting with people I know who started companies. Well, not to ruin the ending, but that's ultimately the conclusion I came to, was that, the problem with VC wasn't actually the companies that it was investing in. It was with the companies that it wasn't investing in, and all of the value that is killed because this venture methodology only recognizes, unicorn grand slam success as success. So if you are building a company that, to stretch the baseball metaphor, is only hitting only like a double or triple rather than grand slams, then you're seen as like worthless. It's almost worse to do that than to fail. And so, but we know, that there are most of those thousands of companies that get started every year really naturally are only able to become doubles or triples at best. And so when there is no capital for companies like that to grow, or venture capitalists are telling all of those entrepreneurs who are running businesses like that they're either explicitly or implicitly that's not what a company that's not what a startup does. That's not what a startup looks like. You're not really doing entrepreneurship. If you're not able to convince a venture capitalist, then something's wrong with you. And that, I think, is a cultural truism that has evolved over the last maybe 15 or 20 years, particularly in the zero interest rate environment, where if you couldn't raise money from a VC, then something was truly wrong with you. They were just giving money away. So yeah, that was very sad for me to talk to both entrepreneurs who were not willing to make the sort of compromises that VCs were asking them to make and couldn't therefore build the company that they wanted to build, or the ones who did, begrudgingly, or they knew that they were getting into this sort of arrangement that they may not be able to get out of. And I think I said in the book that it was sort of like talking to reformed gamblers, where they just wanted, if I just get to that next round and I'll be profitable and I won't have to raise another round and I can buy out my investors and it'll be fine. And of course that never happens. They're always on the treadmill. They always have to push harder. Often if they push back too hard, they get fired. I talked to several who got fired by their investors for, not pushing hard enough. So yeah, I mean, that for me was really the tragedy. And it's why I dedicated the book to the builders, because, I'm a founder myself of a different kind of organization, but I know how hard it is to start something that is just like a figment of your imagination and you're trying to bring it to life, and to have people who, who claim to know better than you, tell you no, or tell you that you're wrong, or push you in a certain direction, like that just, I felt a lot of empathy for them. So that's sort of what the story of the book became about, is their experiences.
Yeah. You write in the book of venture capital, this is the single greatest driver of negative societal outcomes created by the tech industry. Can you give an example of a company that you think really shows that, the way that the VC model is creating these negative outcomes?
Yeah, well, I mean, everybody's chuckling. I'm curious what companies you all think I'm thinking of. But I'm going to surprise you. I'm going to answer a company called Divvy Homes, which is a company I write about in the book. There's a chapter on housing. Housing happens to be one of those markets where I think that venture capital is particularly ill-suited for the types of companies that we actually need in that space to bring innovation to the housing sector. Divvy was, spoiler alert, a company that offered a rent-to-own product. So people who were kind of like just on the margins of being able to get a traditional mortgage, couldn't qualify for whatever reason, they had bad credit or didn't make enough money, or just needed to get their financial house in order to qualify for a traditional mortgage, but really wanted to get into homeownership. This was a product that they could lease to buy, basically. So Divvy would buy the house for the customer and then rent it back to them. And after a period of some years, typically, I think 3 was kind of the standard contract at the beginning, the idea was that the customer, the renter, would buy the house back from Divvy. So sounds great, right? Helping people who can't qualify for a traditional mortgage get on that first rung of homeownership, get their financial house in order, start to build equity, put down roots, whatever, create stability for their family. But it was a very exploitative model, the way that Divvy did it. And it has a long history in Jim Crow era, Red Line era housing arrangements that were extremely predatory for usually Black home buyers. And this is sort of like the edges kind of rubbed down version of it. So Divvy and Divvy was venture backed, had raised money from Andreessen Horowitz, and Andreessen Horowitz Investor was on their board, was at one point a unicorn, it was worth over $1 billion. It was not the only company doing rent to own. There were also other companies that were not venture backed who had a different model. And, not to get too far in the details, and this is all laid out in the book, but at every point when you look at these, at Divvy's model stacked up against its competitors who did not raise VC, the strike price, which was the price that they agreed that the renter would buy the house for 3 years down the road, was higher. The rent was above market rate. If for whatever reason the person wanted to move out, they had to pay to move out. If they couldn't purchase the home for any reason at the end of the contract, they were screwed. They had to leave, and Divvy owned the house. And their conversion rate from renter to homeowner was less than 50%. And for its competitor, who was not venture backed and had a model where the strike price was lower, the rent was lower, I mean, it was really protective of the consumer, the conversion rate was over 80%. And so you just look at, I tried as much as possible to compare apples to oranges of companies who are doing the same thing in the same market. One has venture capital and the other does not, has figured out another model that works, is a money-making business. It's just not a venture scale business. And where the venture-backed model is more exploitative. And Divvy was one of those examples, and it grew really fast. It bought a bunch of houses, had a bunch of debt to buy these houses, and then all of a sudden the housing market slowed down and interest rates went up, and Divvy went out of business about 3 months ago. Having at the time they owned 7,000 homes in the U.S. So. No, I still to this day don't know. I've talked to reporters who've been reporting on this. I don't know what's happened to the people who live in those homes. Whether they, now their landlord's out of business. Mm-hmm. They obviously don't have the opportunity to buy the house. And, is the new owner going to, honor those contracts? I don't know. But it's one of those examples where maybe it's not the Uber where it's making headlines and you see the exploitation, but they're cutting corners at every step. There's a lot of reporting about sort of maintenance on the home. Most of the maintenance costs are pushed to the consumer. The stuff that Divvy was supposed to be responsible for, they sort of give people the runaround and never do it. Their eviction rate was very high. So it's just like a very good example of that. Cut corners, don't do right by your consumers, intentional thoughtlessness that will help you gain market share faster. And they did. They were way bigger than all of their competitors.
Mm-hmm. Well, there's a couple of things that you talk about as being part of the VC playbook that just kind of turn normal business practice on its head. And one of them is that idea of being as big as possible, having no competition, if possible, or scaling so quickly that competition can't begin to emerge before you've taken over the market. And the other one that was really striking to me was that it could be viewed as negative for a company to have revenue too soon, which is wild, right? Because we think businesses should be making money. We were talking about in the fundraising process, if a company has revenue, then that can actually be a detriment. Can you talk about that? Well, not
revenue. Did I say revenue? Profit.
Profit.
Yeah, because if you have profit, then you're not spending enough money, right? Mm-hmm. And you should be spending more money in order to grab more market share. That's money that could be going into opening in a new city or hiring more people to do whatever it is you do, or, advertise, do marketing campaigns. I mean, if you're bringing in money too early, then there's more market for you to go get, is I think how it's seen. And there's a term that is a sort of pejorative term in Silicon Valley, a lifestyle company, lifestyle business.
Right. Tell us about what a lifestyle company is.
Well, it's basically a company that's profitable, or it's growing in a way that is, growing linearly and not trying to take over the world. And it's called a lifestyle business because it's the idea is that it's the kind of company where the founder can live a good lifestyle. Like they're not eating ramen in a garage and sleeping on the beanbag chair in the conference room or whatever, in order of working 80 hours a week. Like they have a life and a family and they get paid at a competitive rate and all of that. That's just a lifestyle business. That's fine, but it's not what we do. It's not what we do. And that really, to me, that was the fact that running a solid business that can support itself and doesn't need investors to, develop, is a threat to the venture capital model, because as I described, in order for VCs to make more money, the companies they invest in always have to constantly be raising more money. And if they don't need to raise more money, if companies can just survive after a certain point on their own, then that is a threat to the whole venture capital industry. Mm-hmm. And so I think it displays a little bit of self-consciousness on their part that they know that a company that can just succeed and doesn't need them is sort of operating on a different plane.
Interesting. Yeah, that a profitable company could be a bad thing. You tell the story of Local Data, which is a startup that kind of follows this model, right? They find a business niche that is manageable, but not on the scale that VC is looking for. And then they start raising venture capital. Can you talk about what happened to this company when they went down that road?
Mm-hmm. So Local Data was a company that was born out of a fellowship at Code for America. and the fellowship project. So Code for America's model is it would take young designers, technologists, and deploy them to cities across the country for a year to work with the city to build something that would help improve city services with tech and design. And this particular team went to Detroit around the time that Detroit was sort of at the rock bottom, or maybe just coming out of their the post-recession sort of crash that would turn into a bankruptcy. And a big problem in Detroit was blight, and it's a huge sprawling city that had shrunk a lot, so there were a lot of properties that were not occupied, not taken care of, and the city needed to prioritize like which ones to take down, or where they weren't collecting enough property taxes. So Local Data built this tool that would allow, and at the time, city workers were just walking around to neighborhoods and writing down on paper, taking this paper back to the office, and somebody else would have to sit there and try to decipher what was on the piece of paper and enter it into the database, and it caused all these errors. So, mobile apps were still pretty new, high tech, very innovative kind of things at the time. And they were built an app that had people who were walking the streets, instead of writing on paper, they could enter the data directly into the database themselves. And this was a huge breakthrough and saved the city a lot of time and money, but also the data was better because there wasn't this sort of chain. And there was a lot of interest from other cities who wanted to use it, and there were other ways in which it could be useful to other cities. So Local Data decided they were going to turn this into a company. They had customers right off the bat, so they were one of these early companies that was profitable almost right away. They got into a couple of accelerators, and this was the time, it's the early 2000s, when if you were doing a tech startup in San Francisco, there was no question that you were raising venture capital, right? That was just what you were going to do. And so they went on that track. And I don't think and I talked to one of the founders, her name's Alicia. She was just very naive at the time, and she was taking the advice she was given to raise VC. And her VCs VCs she was pitching were saying, yeah, this market isn't big enough. You should really go after real estate. So they started pivoting away from their government clients and trying to reshape the product to work for a real estate market. Real estate wasn't ready for it yet. And ultimately they couldn't make that play work. So they weren't able to raise much venture capital. And so they decided to shut the company down because they weren't able to raise enough VC to grow to the other markets they wanted to go to. And Alicia told me the story back, it must have been 2013 or so. And I was like, what? I don't understand. You had a profitable company. Why would you need to shut it down? Mm-hmm. And that was so deeply implanted. It was the first thing I thought of when I came back to this issue, 10 years later, was that story. And it was that, if we can't raise venture capital, it's not really a viable company. If we're building a tech company, that's what you do. Mm. And I talked to Alicia, almost 10 years later, I guess at the time when I was researching the book, and she's like, I just didn't know any better. What if somebody had told me, what if there were other options that I didn't know about? Nobody told me, or I could have gone to get a bank loan or something. I just didn't know. It was just taken for granted that I would raise venture capital. We got pulled away from the customers that were working, and then we're so out on a limb that we couldn't really figure out a way to get ourselves back and had to shut the company down. So that was just a perfect example of all of the ways in which, when I say that I think the problem is less in what companies VC is investing in and more in what it isn't investing in, that's a perfect example of the kind of company that doesn't exist anymore, mm-hmm. That could have created a lot of value. And of course, we all know that real estate got on board with this. If they had been alive and just been serving the government customer for 5 years or whatever, and then when real estate was ready, been in a position to take advantage of that market, they could have potentially have been a venture scale company. And so that's the irony of it as well. And that's why I said in the book, I think VC is killing more value than it creates.
Yeah. Well, you talk about the way that VC is introducing risk to businesses that they don't need. And I think that local data is such a good example of that. I think another area where I see a lot of risk coming from this model is in labor markets. And I would love to hear from you about that, just the risks that are being created, I think for the gig economy, obviously, and for low-wage workers, but also for people who work in the tech industry themselves.
Well, I'm still sort of formulating what I think about the connection between VC, AI, and workers, which is how I think this is going to play out for workers in the tech industry, ultimately. But, I guess I will say from the model and what I write about in the book, the gig economy is one thing. There's also, in that kind of mentality that we are not, so Uber is the perfect example of this, a marketplace. They're a marketplace business, right? And a marketplace is a very popular VC business model. So if you come in and tell a VC you're building a marketplace, it's like, oh, sign me up. That's like, and I talked to many entrepreneurs who said, well, we told them we were a listing service or we were whatever. And they would say no until we started going in and saying we were a marketplace. And then we were able to raise all kinds of money.
Right. And for Uber, this means that they don't have drivers.
They're not they're not a transportation company, Kate. They are a platform that connects delivery people or drivers with customers. And so at the time when I was writing this chapter, it was like the whole fallout from Prop 22 and AB5, and all of the labor people that I worked with were, they were seeing this as like, oh, it's more expensive for these companies to hire these workers as employees, and that's why they're doing it. And that is true. But I think there was more to it than that, which is that if they had to concede the point that these workers were employees, then what they were also conceding was that they were not a marketplace business. And that was a threat to the value proposition they had sold all of their investors on. And so that's why I think they treated it as existential. And at the time, it has since been outspent, but at the time it was the most expensive ballot measure in California history. So they went to the mat on that because it was identitarian for them. It went to the core of who they were, not just their bottom line.
Yeah. Maybe we should talk actually about Prop 22 and what that was. Basically, Uber codified a law for themselves here in California, right, to say that their drivers were not employees and could never be employees. I covered it at the time. It was a really fascinating process, and I think it's still being challenged in court.
No, that's done. Well, there is a bill. What the court said was that the legislature could make a law that allowed gig workers or drivers to unionize, and so there's a bill that's moving through the legislature this year that would allow them to do so.
Yeah. So, I think that's one of the levers of accountability, right, for venture capital and for tech companies, is that regulators step in and try to do something. And I think we saw that play out, like you said, with AB5, where the legislature passed a bill saying these drivers are going to be employees. And Uber said, absolutely not. We're going to put our own thing on the ballot to invalidate this.
So in fairness to Uber, it wasn't just Uber.
Right.
It was all of them.
Right. Yeah. Well, I think, it speaks to your point of this being like an identitarian issue, that it would collapse them as a marketplace business, but also all the other marketplace businesses, the DoorDashes, the Airbnbs, the Lyfts, et cetera. So what are the other levers of accountability that can kind of check this model?
When you say this model, do you mean VC?
Yeah, the VC model.
Well, when I guess when I got to the end and was thinking, like, how do we fix this? It was less about, and when I work on policy, so every time I'm always looking for a policy solution. I actually don't know that there are certain ways that public policy could help, but mostly it's a hearts and minds thing. Like, I think founders could seek out other types of investors. Investors could, limited partners could put their money into fund managers who are operating in a different kind of way. more investors could try to develop methodologies. I profile one in the book who's come up with, I think, a really cool methodology for investing in startups that aligns the financial incentives with the actual business models of the companies. So I think there's a lot that doesn't necessarily have to be the public policy lever that could change a lot of how this, and if you can prove that this different way of investing in companies works, and the way that I outline in the book of just like finding ways to align incentives with the actual business models of the vast majority of startups that get created every year, capital will come to that, right? If there's anything I'm sure of, it's that when rich people see other rich people making money, they will come over and start doing that thing. So, I think it could be an emergent asset class, and it wouldn't take that much public policy to make it so.
Yeah. Well, that was one of the things I actually wanted to ask you is what would the incentive be for the limited partners to put pressure on VCs to make a difference? And perhaps it's that they see another model where other people are making money and they say, okay, I want some of that. Yeah.
They don't really need to. Right now interest rates are so high. VC is not returning to limited partners. I think right now limited partners could say, like, what do I have to lose to put this money that I need somewhere to put into a fund manager who's trying to do it a different way? Like, they don't need to put pressure on their existing GPs, the venture capitalists that they invest with. They can just take some of their billions of dollars and put it into another type of fund, right? I'm not calling for like a divestment from venture capital at all. I think there's plenty of money to go around for these other types of funds to prove that there's another way to do it.
So bringing this into the present, I think we're seeing right now in the news this really new and surprising alignment between a lot of tech CEOs and the Trump administration. Can you talk a little bit about where you see the VC mindset kind of contributing to or supporting that alliance?
Yeah. So when I titled the book World Eaters as sort of a reference to a Marc Andreessen essay from 2011 called Software is Eating the World. And it was about how, this new industry at the time was like a software industry, was actually going to take over every industry. And my argument was like, it's not actually software, it's the venture capital model that was taking over the world. And so it was fitting for me that like Marc Andreessen was one of the most vocal venture capitalists, high profile, to sort of align himself with Trump this time around. And in so doing, he helpfully, and this is the thing about venture capitalists that was very helpful to me, they like to talk a lot about what they do and how they do it and their thought process. And so he went on a podcast circuit and talked about why he aligned with Trump. And the way he described it was something that he called the deal, that there was a deal with, he doesn't specify who, I'm filling in the blanks of like the Clinton-Obama era sort of presidential leadership administrations, that VCs and Silicon Valley broadly would be left alone to make all their money and build their companies and do what they were going to do. And the good that would come from that would be enough. We wouldn't need to do regulation. Like a lot of problems were just going to be solved as a natural result of these companies doing what they do and VCs making a lot of money. But like the agreement, the unspoken agreement was like, yeah, you'll do charity, like you'll set up philanthropies, and you won't whine that much about how much taxes you're going to have to pay. And in exchange, we will, and this is very important, we will call you heroes. You will be considered like the great men of history. And then things change. And I don't actually think this was Biden when these things changed. I think it was Trump's first election. I think the writing was on the wall that era was over. And basically what he was describing was the neoliberal economic order, right? The free market era. And the reaction to that led us to Trump in the first place was a populist reaction. And that was the first signal that we were getting away from that, right? And so it's telling that there are presidents that could not be more different from each other than Trump and Biden that have, and by the way, Trump in his first term and over Biden's term was way worse rhetorically to tech than the Biden administration was. I mean, he threatened to throw Mark Zuckerberg in jail.
Right.
And I don't know if you ever watched the Republicans in the Senate call these guys up, so they were bad. So it was like, it spans parties. And that's the biggest indicator that this is like the breakdown of that old economic order. And this is why working with the Global Fund for a New Economy on this is so important, because this is the work they're doing, is thinking about like, okay, that era is ending. What is the new era that's coming? And this moment now that I think Mark Andreessen's like rush to Trump is a sign of desperation, that he knows the party's over. And I think even now, and this is what I'm excited to talk to you about in particular, is I wasn't sure how this tension between populism and the broligarchy was going to play out. And it seems like, at least for now, it could be different by the end of the week. It seems like the broligarchy has lost, and populism is going to take the day. And I don't know, like what. And Mark Andreessen has been very quiet for the last couple of months. So I am just really. I think it's going to be very interesting to see how that plays out. What that means for tech. For me, it's definitely a signal that this economic era is over, and whatever comes next, and there will be something after Trump, I don't know when or how much damage will be done in the process, but there's an opportunity to build something new. And I think it will be critical that we have an innovation ecosystem that is serving all the companies that are being created and not just kind of pushing for Grand Slam style returns.
Yeah. I mean, so I think that is a really important question. What comes after the VC model? And when we're in this period of, I think, pretty extreme economic uncertainty, where do we think our economy is going? And what is that future of, an economy that supports innovation? What does that future look like?
It might be in Canada or France. I think if I'm looking for silver linings, maybe this moment gives us an opportunity to build in a different way and to start to experiment with some of the models that I outline in the book. Investors, limited partners can take a different kind of risk. A new venture capitalist has nothing to lose by setting up their fund in a different way. An entrepreneur who is starting a tech company should look for different kinds of options for how to grow their business. And out of those little like green shoots, hopefully there will be enough that is alive at the end of whatever this period is, however long it lasts, that we can build from there to go forward. But something that looks more, I don't know what, like aligned. I keep saying aligned, and I feel like that's a lame business term, but like that matches the need, right? Like there are a lot. This is the tragedy for me is like in the housing space, we need innovation in the housing market, and it is not companies like Divvy, right? And we need companies that can actually address the affordability crisis. How do we encourage the ingenuity of people who claim to be these outside of the box thinkers in Silicon Valley to try something different? And maybe this is a moment where that can happen.
Yeah. Okay. I want to dive into our audience question stack over here because I have quite a few. Okay. This person has read the book.
Oh.
They say, you list several smart, practical, but difficult solutions at the end of the book. Sorry for spoilers. Where do you think makes the most sense to start, and what's the first step? Or how do we get together to figure it out? So
the thing that I am hoping, and one of the, I wrote this book to be a platform for work we could do at Tech Equity. So the way I'm thinking about this process is there's kind of three different, first of all, is just, starting this conversation and having people think about the role that venture capital plays in this process. Then there's the hearts and minds piece that I mentioned. And I think on that, you start with the limited partners who, at least on paper, have the most incentive to support building a new innovation ecosystem. So like our funders, the Ford Foundation, the MacArthur Foundation, they have multi-billion-dollar endowments that are invested in part in VC. Like they are the limited partners who are making venture capital possible. If they decided, okay, we're going to take some small slice of our endowment and invest with these different fund managers to prove out whether this is even something that is doable, that could be a very good start to then, catalyze this new asset class that would attract other investors. And then on the policy side, I am interested in the role that the state can play. And I saw plug for Chris Hughes's book talk, which will be here in a couple of weeks. He wrote a book called Market Crafters. And I think there is a role for government to play in sort of this, for lack of a better term, like industrial policy for innovation. How can governments, maybe not the federal government now, but like, what if California had a fund? What if they were a limited partner? What if the state had a fund whose purpose was to spur innovative, homegrown California companies that were trying to hit doubles or triples, or for whom that was the natural outgrowth, or that were addressing the housing crisis, or something that had a policy thing that California needs to solve, and that could encourage this new sort of environment of economic activity that would be really good for the state. Like, I think that would be an interesting experiment. And so we're thinking about like, what are the policy solutions we could also craft? I think all the federal stuff is off the table for the time being.
What makes you say that? Okay, can you talk a bit about how the perception of success of these unicorns and the halo of inevitability also prevents meaningful attempts to regulate them to address negative externalities?
Well, I guess I'm going to read into what is meant by halo of inevitability, but I do think that part of the blitz scaling method is become too big to fail, kind of. Like, once you reach a certain market size, it's going to be very difficult for anybody to undo you. And I think that's what, you see that play out with many of the biggest tech companies. I think that the challenge is, for me, like thinking about how to address these companies once they're already that big is sort of chasing the last, fighting the last battle or whatever. Mm-hmm. So that's why I'm so focused on the next generation of companies, like all this money that's getting funneled into AI right now terrifies me. And then what's coming after that, quantum computing or whatever the next thing is, how are we addressing where that money flows and getting to it before they are the big companies? Because, Meta's on trial right now. The game is over. Like, Meta's done it, it's done its damage. And trying to hold them accountable now while not paying any attention whatsoever to all these companies that are Scale AI is look it up. Probably the most threatening company, I think, startup that you've never heard of. And we're not thinking about how to address the fact that they're getting that big and they're entrenching themselves. So I guess the answer is sort of a cop-out, focus earlier in the cycle and make sure that the capital environment is allowing companies that don't need to rely on that exploitation to thrive as well.
Yeah. I'd actually love to ask you to talk a little bit more about the current VC flood into AI and why you find that so particularly concerning.
Well, I heard from a lot of VCs interest rates are high now, so this is over. This was just what you're writing about is so 10 years ago. This was just a outgrowth of the ZERP era. And it seems to me, when you look at how they're investing in AI companies, that they have not learned that lesson. Mm-hmm. So I do think that that's kind of a signal that things haven't changed and that the macroeconomic environment is not really hemming them in the way that they claim that it would or it should.
Got it. Okay, next question from our audience. Do you have concerns about the growing venture philanthropy movement and the way it's mimicking VC?
Venture philanthropy. Oh, well, like social impact investing, I guess. Yeah, so one thing that I don't have a lot of thoughts on that.
Okay.
But I will say that, I have been getting sort of, when people hear what I describe as the doubles and triples in the market that I think we should be investing in, what they hear, and I think this is an effect of the culture and the like powerful narrative that Silicon Valley has been able to spin, is what they hear when you say double and triple is, oh, social impact. Oh, you're leaving money on the table.
Right.
And that's not what I'm talking about. So like social impact, I do think that, I did hear from a lot of entrepreneurs that like they would, if they didn't take VC, the only other option was social impact, and that they had the same expectations basically as the mainstream VCs did. And they also wanted the social impact, right? So it was like, no, you're going to do this on skis and, spinning plates at the same time.
Well, and I think the VCs also want the social impact, right? They want that heroism of like, we are saving the world, we are doing
No,
this.
they don't. No, they don't.
Well,
No.
you were just talking about Mark Andreessen wanting to be called a hero.
Well, he wants to be called a hero, but he
Right.
doesn't want social impact,
Yeah.
value neutral social impact. Yes, they are impacting society for sure. I think they're, there was the social impact I'm talking about is not values neutral, but more like, how do we develop a market friendly way to like solve hunger in Africa or whatever.
Right. Okay. CEO compensation is obscene. You must have some opinions. How does this relate to VC risk versus reward?
I do not have opinion.
Okay.
on CEO. So sorry, read it again. CEO.
Compensation is
Compensation is
obscene.
obscene.
How does this relate to the VC concept of risk versus reward?
Well, I mean, there is like a moral hazard issue, I think, in both cases. I think it's also an indicator of like this, the financialization of everything. And I think the way that VC has evolved is really the financialization of startups. And that goes back to this point about like, you're not really selling to the market or customers, you're selling to other investors. It's sort of like a derivative product at this point. So I guess that I would say that those are the parallels I see.
Got it. Okay. This one is interesting. Startup tourists from all over the world come to SF in Silicon Valley to chase venture capital funding. Mm-hmm. These tourists have boosted the local hospitality industry. Is this a positive or a negative?
This feels out of my realm.
Yeah.
I don't know. I don't know.
It's maybe
what
good,
do you think?
It's maybe good for Airbnb's business. I don't know. I think this is interesting. I don't know. Like everything I hear about like local hospitality stuff is that it's suffering, and especially, post-pandemic, that tourists aren't returning to San Francisco in the way that hotels have hoped. But yeah, I don't know. I mean, I think like San Francisco has always been a tourist industry to some extent, and that predates the like VC model. And so I think like people are going to flock here to do tourism regardless of whether or not it's seen as like the epicenter of venture capital.
Well, I definitely think it's there's a parallel to the gold rush, right? Mm-hmm. And so, this sort of mythology around Silicon Valley and people coming from all over the world to start their company here is, I heard from a lot of engineers that like all the bad shit about Silicon Valley is actually the Wall Street dudes who moved here after there was money to be made. It's not engineers who are causing the problems. Like engineers just want to build tech. Everything that's wrong with Silicon Valley is the Wall Street bros who got a whiff of some other way to make a profit.
Interesting. Okay. What steps have to be taken to fuel ventures that democratize governance? In other words, if the current trend continues to run its course, only a very select few will be gods, and the the rest just takers, I believe. Sorry,
Yeah.
I'm struggling with the handwriting there. How can we flip this narrative through VC?
Well, I mean, I think that's essentially another way of saying what I'm saying. I don't know that I would call it democratizing access to startup capital, but that would ultimately be the effect of a model that had different, options for different types of companies. Right now, it's just one path that sort of every VC is offering. And if there were a variety of paths, I think that would create more opportunities for like broader based wealth creation. And it would help, to not sort of consolidate wealth in the hands of just a very small number of people.
Okay, this one says, first of all, amazing and insightful book. Is there a reason you didn't discuss the impact of venture on biotech and life sciences?
Because
Would you
I
like to talk about
a full-time
Theranos?
job, and don't ever write a book while you also have a full-time job is my advice. There's a lot of stuff I would have liked to talk about. I did talk about Genentech a little bit at the beginning. I mean, this is one of those areas like the hard sciences where that VC model in the beginning, like pre-software era, was actually very useful because where was a company like Genentech going to get the money to bring, mass market insulin, to like commercialize mass market insulin, And I think I say at the beginning of the book, like there is a role for VC in the economy, and it has undoubtedly made our world better, our lives better. But it's gone way, and that's why it's called World Eaters. It's gone way past the areas where it really can do the best, most good.
Yeah. I think we have time for one more question. What do you think needs to happen in policy or practice to promote the creation of more socially conscious VC funds, such as the Kapor VC funds that invest in gap narrowing firms?
Yeah. So I think Kapor is one of those examples of the type of fund I'm talking about that has a different methodology, is looking for those companies that can hit doubles and triples. They have the benefit. I mean, I know they do. I'm pretty sure they raise from other LPs, but they also have, a single wealthy benefactor who founded the fund. So it's not just like some guy off the street who started a VC fund and then can operate. So it's coming from a little bit of a place of privilege to get the ball rolling. So it's, but I would say, like I said earlier, the market crafting piece, like I think there's a program at the Small Business Administration called the SBIC program, which is essentially a limited partner that funds different types of funds. I think that there are ways to like reshape that program so that that money could go to fund managers who are operating in this way. I think the limited partners, like the private foundations that are invested in responsible tech programming, could play a role in seeding that fund. But I do think that it's going to take, there may be some of you here, venture capitalists who, like, I thought would be really angry at me or like take offense to the book, and there is some of that. But a lot of them have been like, oh yeah, that's right. That is how it is. And they're not the Mark Andreessens of the world. Like, they don't have the power to shift how this system works. And if there was an opportunity for them to do it a different way, maybe they would. But if they walked into a limited partner's office right now and said, hey, I want to do this thing that's going to make you money off of doubles and triples, they would never raise a fund. So I think we do need to start getting those catalyzers to just take the first step. It would be like marginal money as far as they're concerned. And it may have much longer payoff, huge upside potential in the long run.
Yeah. Catherine, thank you so much for doing this and for sharing your work with us. I really appreciate it.
I'm sorry we didn't get to talk more about Elon Musk.
I know. Next time.
How do you feel about being the world's expert on Elon Musk?
I think he's a fascinating character, honestly. He sits at just such an enormous nexus of wealth, power, delusion. There's just a lot of interesting stories to tell there. But yeah, my co-author Ryan and I talk about this all the time. We did not expect or anticipate for our book to be relevant in quite the particular way that it is right now.
Is there a sequel coming?
We are not working on a sequel at this point. But
It'd be a really good book.
We are so slammed right now on the reporting for the paper. But yeah, he's a fascinating character, and I think something about him has always been very compelling to me. He's just a very interesting guy, and he kind of lets it all hang out there in a way that other tech founders of his stature, the Zuckerbergs of the world, really don't. And so there's something that's just very interesting to me as a writer and a reporter there. But you guys, please give Catherine a round of applause. Thank you for sharing your book. And please pick up a copy outside or at the bookstore.